All right, welcome to The Explainer. Today, we are diving into an analysis of the stock market that's, well, it's fascinating and maybe a little alarming. We're seeing record highs, but as we're about to find out, the celebration might just be happening on top of a very shaky foundation. So for this deep dive, we're actually looking at a great example of the kind of analysis you'll find over at philstockworld.com. And just so you know, the founder, Phil Davis, is recognized by Forbes as a top influencer in market analysis. So yeah, we're drawing on some serious expertise here to figure out what's really going on. I mean, on the surface, everything looks amazing, right? The big indexes are hitting new records pretty much every week, and the mood, the overall feeling is just euphoric. It really feels like this party is never going to end. You see these big round numbers flashed on the screen, a future target like Nasdaq 25,000, and it's so easy to just assume that means everything is strong and stable. But the analysis we're digging into today suggests we need to look much, much closer at what's actually holding these numbers up. So, what if it's all just a big illusion? This is where we really start digging in, because the argument we're about to walk through is that this entire rally might be built on a foundation that's way shakier than most people think. We're going to go clue by clue. All right, section 1. Let's start by looking for the cracks in the foundation. These are the kinds of systemic risks that are kind of hiding in plain sight, but could threaten the whole structure. And the first clue is a huge number. According to the source, there's still $395 billion in unrealized losses sitting on bank balance sheets. This is like a ghost from that 2022 banking crisis that the market has just decided to, completely ignore. It's like everyone is just pretending that hole isn't there. Okay, check this out. This chart shows the second major crack, and it is a big one. Extreme concentration. I mean, think about this for a second. Just 10 stocks make up more than half the value of the entire Nasdaq. The fate of the whole market is basically riding on the shoulders of a tiny handful of companies. But here's where it gets kind of spooky. The source points out that we haven't seen the market this concentrated since the late 1920s, right before the infamous crash of 1929. Yeah, that is a pretty chilling comparison. And this dependency is just staggering. The Magnificent Seven, those big tech giants, were responsible for almost 87% of the S&P 500's total earnings growth last year. You take them out of the picture, and the rest of the market is just flat. No growth at all. And some of the valuations, they are just off the charts. Seriously, look at Tesla. The source notes it's trading at 248 times its earnings. Now, that's already sky high, but what's really wild is that it's happening while Tesla's earnings have actually been cut in half. So you gotta ask, right? If the foundation is so cracked, what in the world is holding this thing up? Well, the answer, according to our source, is pretty simple: a tidal wave of cash, or, as the experts call it, liquidity. And we're not talking about a little bit of money here. We are talking about almost incomprehensible amounts of cash flooding the system from 3 giant taps. Trillions from a Fed facility, trillions from companies buying back their own stock, and trillions more in government spending. It's created this massive engine just pushing prices up and up. And here's the really important part. This river of cash creates this feedback loop. It completely disconnects stock prices from reality. Because when there's that much money chasing the same few stocks, fundamentals like whether a company is actually making a profit start to matter less and less. The price just keeps going up. Okay, now we get to what might be the craziest part of this whole analysis. The source calls it the Great AI Shell Game. And it's the argument that the AI boom, the very thing driving those big tech stocks, might not be what we think it is. The article uses this perfect analogy. Imagine a tiny town with just 4 people. Now, what if they all just start trading with each other, passing the same money around in a circle? On paper, the town's GDP would look massive, but is any new money actually coming into the town? Nope. So here's how the shell game works, according to the analysis. Step 1, Microsoft invests, say, $13 billion in its partner OpenAI. Step 2, OpenAI turns around and spends a huge chunk of that, like $6.5 billion, on Microsoft's own cloud services. And then, step 3, Microsoft gets to report all that spending as new revenue growth. It's basically their own money coming right back to them. And if you're thinking, Is there any proof of this? Well, the article points right to the data. Take a look at NVIDIA, the king of AI chips. More than half of its data center revenue comes from just 3 customers. And you can bet those are the same tech giants passing all this money around. So here's the kicker, the real smoking gun. While you see these giant exploding AI revenue numbers being reported, the argument is that the amount of actual new cash coming in from real outside customers is tiny. The rest? It's just that same pot of money being passed around the circle. Okay, let's recap. We've got hidden risks, insane concentration, and growth that might just be an accounting trick. So, what happens next? Where does this all lead? Well, the forecast isn't exactly rosy. Investment bank Goldman Sachs is projecting a 10-year average return of just 3%. To put that into perspective, that's one of the worst outlooks in almost 100 years, a period that includes the Great Depression. Let that sink in. And it's because valuations are just stretched to their absolute limit. There's a metric called the CAPE ratio, and right now it's in the 97th percentile. To put that simply, we are in one of the 3 most expensive stock markets ever, in nearly a century of data. And look, at the end of the day, you just run into a simple math problem. For these massive multi-trillion-dollar companies to keep growing like this, they need more and more and more capital. The source uses a great analogy. The world's bucket of water just isn't big enough to keep filling their gigantic, ever-expanding swimming pools. It's mathematically unsustainable. And that really brings us to the final haunting question this whole analysis from philstockworld.com leaves us with. It challenges all of us to look past the hype and really question what this rally is built on. When a market defies reason for this long, what happens when reason finally decides to make a comeback?